to wait just another 2 minutes before we start the meeting, and I'll be back to you. Ago that I need to read this. So welcome to the virtual May 11th, 2020 regularly scheduled meeting of the West Hartford Pension Board. My name is Nancy Dean and I'm chair of the board. Because in-person attendance at public meetings is likely to increase the risk of transmission of COVID-19, this meeting is being conducted in accordance with Governor Lamont's Executive Order Number 7B, which permits municipalities to conduct public meetings virtually. Members of the board and some town staff are participating by WebEx, and members of the public can view the meeting live on West Hartford Community Television or on West Hartford Community Interactive Comcast Channel 5 and Frontier TV Channel 6098 or at www.whctv.org. The meeting is also being recorded for on-demand viewing, which will be available on the town website. Because of the virtual format, there are some special rules and procedures that I need to cover before I begin. First, I ask that all participants to please mute your devices when you are not speaking. If you wish to be recognized, please raise your hand, and I will call on you in the order I see hands go up. If you are participating via audio only, or I do not call on you and the debate is ending, then please unmute your phone and let me know so that I can recognize you. Second, main motions will be made by me and no second is necessary. We will proceed immediately to debate. These include motions to adopt, receive, or approve business items. Subsidiary motions still require a second. These include motions to amend. A member must be recognized before making a subsidiary motion, but any member can second a motion by just unmuting their line and saying second. Third, pursuant to Executive Order 7B, all speakers must state their name and title each time they speak. At our last meeting, we had Dallas Dodge Corporation Counsel help remind us every time that we needed to do that. He is not with us this morning. They feel that we have graduated to handling this ourselves, so I would just remind you all to do that, and I need to remind myself too. Fourth, because of the difficulty in tallying voice votes on a video conference, I will require that all votes will be taken by roll. Lori Carney will be doing that for us. Fifth, a reminder that if any participant has a problem with their connection, you should immediately call Jareda Reinheimer, whose phone number you were provided earlier. She will let me know and we will recess the meeting while the problem is resolved. If it cannot be resolved quickly, we will ask you to call into the meeting using a phone and participate by audio only. Because this is a new format, I want to thank everyone in advance for their patience as we learn from this experience. Thank you very much. I will now ask Lori to call the roll. Lori? She hasn't unmuted. Just a second.
I'm here. Okay. Nancy Dean,
Here.
Lazaro Guzman,
Here.
Eric Halpern,
Here.
Alan Lebo,
Here.
Brittany Bermingham,
Here.
Peter Privatera,
Here.
Mayor Cantor,
Here.
Matt Hart,
Matt Hart, present.
Chris Kashmar,
Here. Good morning.
good morning, Rick Ledwith,
Rick Ledwith is here. Thanks.
Paula Kanaki, I think she might be muted.
Yes, she may be
Yeah,
muted.
I know she's. I know Jen
I'm
Evans.
here. I'm here.
Hi, Paula.
Lori, I'm here. How's
Got it. I'm not sure if Jennifer Evans. I think she's muted. Oh, hi, Jen.
Good
Okay,
morning.
thank you.
Thank you, Jen.
Mike Elquist.
Listening intently.
Is there anyone who's participating whose name I did not call? Okay, I guess we're good.
Okay, great. Thank you, Lori. So good morning once again. Thank you all for participating in this format. It's getting a little bit easier. I think we're all getting used to this in other aspects of our days, but it's still not quite the same as being together. We do have a reasonably full agenda this morning. We also have a target to close the meeting by 8:50. I know that those from the town have a meeting at 9 o'clock, as well as some of our members. So we will do our very best to get through to that point. So with that in mind, I will turn it over to Pete, please. Peter.
Good morning. Good morning, Pete Privatera, Director of Finance for the town. I just have one item I'd like to bring up and discuss. Given that it looks like we'll be doing this for a while, and from a procurement standpoint, it's been kind of difficult putting out contracts and renewing contracts. And frankly, I'd like to put out a suggestion or a recommendation to the board that we maintain FIA for one more year. Their contract is due to expire. It's been difficult, working in this type of environment. And I think it wouldn't make sense at this point to try to go out for an RFP and start with possibly a new vendor if that was the will of this board. Given the fact that that after we adopt the budget, my next priority is to start working on pension obligation bonds. It doesn't make any sense for me, to change horses in the middle of a race. I think FI is doing a great job, and I'd like to ask the board for their consideration to at least extend their contract for one more year until we get through this, and then go out with a formal process and see where we go from there. So that's what I'd like to recommend to the board. Thank you.
I think in this new format, I need to make the motion, Peter. And so I will make a motion to continue the services of FIA. Their current contract expires June 30, 2020 for one more year. And that we will revisit this during the first calendar quarter of 2021. Yes, Brittany?
So typically, how often would we have to go out for bid for a new contract?
Peter Privatera, Finance Director. Brittany,
Birmingham, sorry.
we usually have an initial one-year contract with 3 annual extensions. It's usually a 4-year contract period. We've been using FIA for a very long time, and I guess I would ask the board when it is time to go out to RFP if they'd like to structure it in the same manner. It's usually about a 4-year period.
Any other questions or comments? Alan?
Yeah, so Peter, does that mean that it's been 4 years since last time that we reviewed FIA?
Pete Privatera, Finance Director. It's been longer than that, Alan. The contract that we had, I believe the contract that we had in the past, renewed annually. Last year, I went to the Corporation Counsel's office and asked them if we can just write a one-year contract that would expire this year so we can go out to RFP. We did that with the expectation that we would go out to RFP, but given the circumstances, I think it would be a better idea if we maintained our relationship with them for one more year, then went out to RFP again.
So that makes sense. This is Al Leba. So that makes sense to me, and I have no issue with what you're saying. I am just curious. So when was the last time there was a formal RFP in review?
I would have to, Pete Privatera, I would have to go back and look, Alan. It's been a while. I don't know exactly how long that period has been, though.
All right.
This is Nancy Dean. We did go through a formal RFP process. I believe it was 6 years ago. For our next meeting, I have turned over that timeline to Lori. I will make sure that we put that as for informational purposes as an item on our agenda for next meeting.
Okay.
Any other questions or comments before we go to vote? This is Nancy Dean speaking. All right, then, this is Nancy Dean. I would ask Lori to please take a vote, please.
Okay. Peter Privatera,
Yes.
Brittany Bermingham,
Yes.
Alan Lebo,
Yes.
Eric Halpern,
Yes.
Roger Guzman,
Yes.
and Nancy.
Yes, Nancy.
Thank you.
All right, then the motion carries. Thank you very much. Lori, if you would make sure the minutes reflect that we've committed to putting that timeline in, that historical timeline in our package for the next meeting, that will keep us all on track. Thank you.
Yep, I made a note.
Thank you. Okay, Chris, welcome this morning again. Yes, the markets are slightly better than the last time we were all together, so I give the floor to you. Thank you.
Great. Thank you, Nancy. Chris Cashmar, FIA, and again, good morning, everyone. And we trust you're safe and well. I think you should have from Lori's email last Wednesday a series of attachments beyond just the agenda and related administrative materials. And I think following again in terms of sequence, if you were able to access the updated balances exhibit, you'll see there as of bear with me here as I pull it up. These are balances as of the 4th, so they're relatively current. And I think you'll recall from our last meeting, we do need to raise $2.7 million a month through the end of the fiscal year. And you'll recall we did that at the end of April by virtue of a raise from the fixed income managers. To accommodate that, kind of following our natural intuition, given what markets had done in the quarter and year to date, we had been overweight fixed income. You see in this exhibit as well as of early last week, and again, I don't think the numbers have changed all that much on a relative basis, that the portfolio remained somewhat overweight fixed income. If you can make it out there at about 31.5% fixed income versus the 30% stated target. I think arithmetically, if no one objects, we would look to source from the fixed income managers again proportionally this month and draw that number back down into target. And then we would have to, of course, would want to look in the early June time frame at numbers as well. And I think, right, we don't know just yet what will happen over the course of the next 3 weeks, but I think that we would maybe have to revert to a more proportional raise for the last month of the fiscal year. But I think for this month, we would be comfortable raising everything from fixed income. Again, $2.7 million is needed per month, so $5.4 million through the balance of the fiscal year. And I think, Nancy, that's what we had kind of thought through, made the best sense, but obviously are happy to take in from the board.
This is Nancy. Yes, Chris, that was our top-down discussion. Any questions or comments for Chris at this point? I have one clarification to ask of Peter. Peter, the cash funding that we need to do here for the months of May and June, will we be faced with that in July too, or will we then revert back to the pooled approach of the town's cash?
I wish
too early to tell. Too early to tell.
I wish I knew.
Because this is a very challenging cash flow time for the town, I know.
Yeah, what's happening, Pete Privatera, Finance Director. What's happening is that with the governor's executive order that allows the deferment of tax payments for certain residents, we're planning on the possibility of issuing tax anticipation notes by the end of the first quarter if a lot of residents qualify and are eligible for that. So the process that we used in the past of floating the cash from our pool cash until the end of the year might not work for us this year. So we're just going to have to wait and see how the tax deferment and the low interest program work for the town.
Okay, thank you. I just wanted to make sure everyone was clear on that may be a slight difference in the way that we look at the portfolio in the new fiscal year. Okay. Thank you, Chris. All right. Chris, want to go further on? I think you're okay with that cash raise for May, so we'll go forward. May and June, we'll go forward from there.
Great. Okay. Thanks, Nancy. I guess the last thing I would do before we move on to the next topic, if you'll permit me just quickly here, you'll see balances. I should have mentioned $202.5 million at the beginning of May. You'll recall at the end of the first quarter, we were down to about $193.5 million if you account for the $2.7 million flow that occurred in that as we just described. I think I don't have all the arithmetic just yet, but it looks like the portfolio was up about 6% in the month of April. So that's obviously encouraging on the heels of what we've already chatted about, which was, of course, a very difficult Q1. Anything else on that front? If not, the other thing we had done and talked about is trying to stay afoot with opportunities in the marketplace. And I think, as you all know, we're obviously trying to do that in real time in a dynamic fashion. And one of the, we offered up two pieces of collateral for the board's consideration in the dislocation in the markets in March, as you well know. One of the areas that got particularly pressured was the high yield arena, the domestic fixed income high yield arena. And we, in your packets, I don't know if folks had a chance to review it or not, just a quick summary memorandum that kind of related to historic periods, or prior periods, I should say, when spreads in the high yield arena had gapped out to the extent we saw in March. And which have come back in a little bit in April, but are still comparatively wide, certainly to where they started the year. We can talk to some of those details if the board has an appetite. But nonetheless, in the past, this has been an opportune time to add thoughtful and dedicated high yield as a source of total return in an environment, obviously, as we all know, where base interest rates remain extraordinarily low. So we had contemplated and have been talking to clients, and again, just wanted to put in front of the board for consideration the idea of potentially looking at some dedicated high yield within the fixed income portion of the portfolio. As a reminder to the board, the Vanguard index that you have, of course, bond index, does not have any dedicated high yield because the index, of course, doesn't own any. MetWest, you may remember, does have the wherewithal at their discretion to add limited amounts of fixed income into their mandate. I think when we last looked under the hood in their portfolio, they're at about 6% high yield today. So they have a comparatively small position today in high yield. And we had wanted to at least have the conversation with you folks of whether there was an appetite to add in the form of a dedicated high yield manager, a couple of percentage points of exposure to try to take advantage again of what historically has been an opportune time to put monies into the space. So if I can kind of reiterate beyond that, because I think it's all contained in the memo, but I suspect there'll be a question or two. To the extent there's an appetite, we also offered up to you in the form of a search, a couple of the candidate managers that we research and use for those clients that have decided to make that commitment. It would be a tactical commitment, right? I don't think it would be intended to reside there for long periods of time. It would be monitored as to where spreads go, and to the extent that spreads condense back into their near-term averages. Hopefully, as the world and the economy continues to stabilize, it would look to be peeled off and put back into the standing anchor fixed income managers. Just arithmetically, again, if there's an appetite, we had talked about being thoughtful and fairly constrained with the size. You have a 30% target to fixed income today, as you know, and we certainly would not want to do more than 10% part of that 30%, so contemplating perhaps a 3% dedicated weighting for a period of time to try to take advantage of the opportunity. I think, as everyone knows, right, high yield is below investment grade, so there's no blushing from that. The managers that we've got to monitor and use and are comfortable with tend to focus in the upper quality tiers of that space. But nonetheless, just in full disclosure, it is below investment grade. It's below investment grade for a reason, and we just need to be mindful of that. But when you look historically at points like this, invariably it's been an opportune time to try to be tactical with a little bit of an allocation. So with that, I'll pause for a minute, and I know I mentioned a lot, and let people consume it or ask what questions you may have if there's an interest from the board at all.
Brittany?
Hi, Brittany, Bermingham, board member. Can you explain what below investment grade means?
Yeah, so these are the rating agencies, Brittany, Cashmore from FIA, I'm sorry. The rating agencies, right, tier by quality and financial metrics, the wherewithal of the issuers in the market to repay that debt. And you can appreciate the highest rated credits are AA and AAA and A plus and triple B and higher, definitionally being what is considered investment grade, with a very high ability and propensity to repay the indebtedness that they incur. When you begin to move down the spectrum, below in the major rating agencies, below triple B into the double B and even into the C range and beyond, the ability for those issuers to repay that debt is lower than it is certainly for the higher rated credits. Now, historically, there has not been, and we put it in the memo, there's not been a ton of, even in periods of distress, defaults in the high yield arena, but there are some. So really, honestly, the simple answer to the question is that these issuers have a lower ability to service that debt than do their higher rated peers. And for that lower ability, investors in the marketplace demand higher compensation to lend those monies, as you would suspect. So when we talk about spreads or the incremental yields in the marketplace that are available, they are much higher than they are for the investment grade issuers. So it's a lower rate investment But one, again, that I think done thoughtfully offers up some interesting return opportunities for kind of the aware investor, if you will, and the good managers out there that look to exploit the space.
Thanks, Chris. This is Nancy. Eric, had you raised your hand?
Yes, this is Eric Halpern. I have two questions. I guess the first is, I understand you're recommending that this is a tactical move, not a long-term move. I was wondering if you think the sector is undervalued at this point, or if it's just that the market value is, differs from where it was historically. And then I guess the second is, I don't recall seeing any portfolio analysis related to incorporating high yield. Has anything been done as far as Sharpe ratios, risk return, what it would do to our portfolio as a whole?
Yeah, so I got two, I think, Eric, two great questions. As to the first question, so in terms of values, so it's embedded in the memo, but let me reiterate for the group so we don't have to toggle back and forth. So in kind of the throes of the crisis in March, the incremental yield offered in the high yield arena, broadly, had jumped up to somewheres on the order of, I think 1,082 basis points from a recent average of about 484 basis points. So significant widening of that spread. Spreads have come back in as the markets have settled in a little bit in April. Spreads are back in. I think when I last looked last week, spreads were down in around the 750 range or thereabouts. So still fairly north of that run rate average of 484 that I just mentioned, but they are a bit tighter. There's no absolute or perfect entry point. Certainly 800 basis points is what we reference as a particularly opportune time, right, to put fresh monies into the arena, but certainly at 750 basis points, if we continue to have market stability and some vision on economic stability a little bit in the intermediate longer term, we still think the entry point is a decent one. And the sector or the arena should continue to tighten back into those longer term averages. So I think values are still decent and solid. They're not as extreme as they were 5 weeks ago. So that's a fair observation. The portfolio analysis, I don't have the numbers right in front of us. It would add marginally, right, to modeled risk and return. We do have higher expectations for high yield on a modeled basis over the long haul versus traditional fixed income, but it is a more volatile return stream. So I do think it would add a touch of modeled return. It would add a touch of standard deviation to the mix. I think in the grand scheme of things, even at a 3% target, right, we're talking about a fairly modest position. The effect on the larger statistical attributes of the portfolio would not be that significant. But we would be slightly more volatile than we would be absent the position, that's for sure.
Any follow-up questions to that?
I have a question, Nancy. Lazaro Guzman, board member. Chris, part of the reason spreads are going up is because people think default rates are going to go up too, given the current economic conditions. So just want to be clear, despite your outlook for the economy and for the impacts to businesses, you still think, with spreads 750, 800, that this makes sense, correct?
Hi, Lazaro. Chris Cashmore, FIA again. Yes, we do, right? In the memo, and again, I hate to keep leaning on that, but we talk a little bit about historically default rates and recovery rates. So even at 750 basis points, I think, Lazaro, if you look at history, right, it would it would still be opportune, and the markets are still pricing in default rates that are well north of anything we've experienced, even in times of crisis, for example, the 08-09 timeframe. So we do still think there's value in the arena. It's 750. And have certainly considered, kind of those default and recovery scenarios, as of course the managers do as well.
Just to going back to Eric's question, maybe you don't have an idea in terms of the complete impact on expected return, but maybe you could answer the question this way: when the expected return on the portfolio, what's your expected return for the asset class versus just core, high yield versus core bond? So what sort of long-term expected return? What's the differential there in terms of your thoughts?
I think in our long-term assumptions, we're running high yield, Lazaro, Chris Cashmore again, I'm sorry. I think we're running high yield at about 125 basis points north of core bond.
Okay.
From a model return perspective.
Okay.
We've got it set up in the optimizer.
And then the last thing, this isn't for you, Chris. Nancy, I looked through the candidates. One of the candidates is PGIM. That's a prudential fund. So yeah. I'm gonna recuse myself. I don't know if you want me to recuse myself from the vote of whether or not to add high yield, but I would certainly recuse myself as we vote on the individual managers, since I work for Prudential.
Right. Thank you for raising that issue. Let me think about that for a second. I have a question for Chris myself. Chris, this is Nancy. The Midwest fund that we currently use does allow a high yield component by their investment mandate, right? And they're at 6% now. Do you know what the range of their exposure is by policy?
Great question, Nancy. Chris Cashmore again. So they buy prospectus. I think they can do up to 20% of their portfolio in non-benchmark asset classes or sectors, right, which would include high yield. I would tell you historically that MetWest profiles pretty conservatively along that core plus manager, universe that we put them in. They tend to use those plus categories very judiciously. So you're not going to see them. Even when I look at the environment we're in now, right? I think that we're constructive, and I think many are constructive on a high yield. They're at a fairly modest range, and I don't think would go much higher than that at all, if at all. So. I think they have been as high, probably in the 08-09 crisis, as high as 8, 9, maybe 10% of their portfolio. They're at 6% today in our kind of conversations with them. There's no immediate consideration to materially increase that number. So they do run fairly low. They can do a lot more by prospectus, but as you can see, they haven't, and I suspect they won't, given the environment. I think they've kind of already made their play there, if you will. So that's a modest single-digit type exposure is kind of on a run rate where they will be with high yield.
Okay, thanks. I think maybe we should keep our eye on that, though, as we go forward for the next couple quarters anyway. If you could make sure to highlight that for us, what percentage they are in their portfolio. I'd like to make a motion now. Before I do that, I think I would say, Lazaro, that I'd like you to vote on the first part of the motion, or the first motion, which will be to entertain opening up the investments in a high yield, increase our high yield exposure on a more defined basis, as opposed to having it be part of the Midwest mandate. But if we get to the point of voting on specific funds, I would ask and appreciate your recusing yourself at that point. So I will make a motion, and then Lori, I will ask you to take a vote, do the roll call of the vote for us. And the motion at this point is to.
Hey.
Pardon. Yes, I'm sorry.
Nancy.
I'm sorry, I missed you. Yes, Eric?
If after the motion, will there be time for discussion? I'm sorry, this is Eric Halpern.
No, Eric, yes, thanks. Yes, as you could probably tell, maybe we needed some more discussion before I make the motion. In fact, why don't we take a few minutes and do that now? Because I'm struggling with the motion myself, to be quite honest. So let me open that up for any further discussion as we go forward here. Eric, would you like to say anything?
Thank you. This is Eric Halpern. I think this is a bad idea for a number of reasons. I guess I can start at the most general and then go down to the most specific. At the most general level, we are investing to back a portfolio of pension liabilities. Those pension liabilities do not have any corporate credit risk in them. And so by investing in high yield corporate credits, we're introducing risk that is not really compensated based on the liabilities that we're backing. I mean, going down one level, it seems that the proposal is based on the idea of market timing. That we are going to get in the market at a good time and get out at a good time. And not only is that counter to our philosophy as a board, I don't think we have a good track record of market timing. The investment we made a couple of years ago in International, for example, was presented as a short-term opportunity as well as a diversification, and that opportunity did not pan out, just as an example. From a personal standpoint, as I look at the markets, this isn't really a great time anyway. We have unprecedented levels of unemployment, and so the idea that we'll by now, when credit spreads are wide, expecting them to normalize over time as markets recover, I think we don't know enough about how markets will recover, given the state of the markets and the state of the economy. And then from a nuts and bolts practical standpoint, we're talking about cash flow and our need to keep liquid assets for cash flow. As we invest in more volatile assets, if it takes time for those bets to play out, they're not going to be available to meet liquidity needs either. And then finally, I would just say I don't feel like we've done our homework here. We don't have a good idea as to how this asset class would fit in from a risk and return standpoint, and what it would mean as far as what it would do to Sharpe ratios and so on. So, for all those reasons, I think this is at best premature and probably a bad idea long term as well.
This is Nancy. Thank you, Eric, for your comments. Any other comments?
Lazaro Guzman, board member. My main hesitancy is the fact that we're thinking about pension obligation bonds, and it sounds like that may happen in the next 12 months or so. I'm not sure. Maybe Peter can comment again on. I know we haven't approved anything, but if there's a possibility that can happen in the next 12 months, I guess I'd be hesitant to change, make a meaningful change to the portfolio, knowing that we've got something else that's happening, within the next 12 months. And then from a timing perspective, if this were a longer term proposition, I'd feel more comfortable. But again, given the fact that we're thinking about pension obligation bonds, and that may happen very quickly here, depending on the analysis, then I'd be hesitant to go into something that maybe in the next 6 to 12 months may not pan out. Where I think high yield maybe from a longer term perspective, but again, given what's happening with the pension bonds, I'm not sure.
Thank you, Peter.
Thank you. Pete Privatera, Finance Director. My hope is to move on pension bonds, as soon as we get through this immediate situation. But, with the uncertainty and all that market volatility, we're just going to have to see what happens. I think that if the if the interest rates stay low, then and it would be an excellent opportunity for us to issue POBs and reduce that liability. But and I'm hoping to start working on that soon. But again, that involves some sort of a collaboration with state OPM, and I'm hoping that they would work with us, but they have their hands full already with their situation. But I do have a question for Chris. Excuse me, Chris. With your other municipal clients, are you making the same recommendation? I'm assuming you are. And how many of your other municipal clients are on board with this? And also, the second part is, I think Lazaro makes a good point with respect to if we are going to do something like issue POBs, is this the right time to go into high yield market? So those are my two questions.
Yeah, so I would, Chris Cashmore, FIA, we are just beginning in earnest, Peter, right, to get into the field with boards like yourselves and have this conversation. We're certainly having that conversation consistently across the public fund practice. I don't have any definitive collateral just yet because I think my particular meetings are still out into the future. But I think we have had a couple of positive reactions to it. I think we've had a couple who've decided to not move forward. So again, we just want to be consistent in the delivery of the message that it may represent an opportunity. It may not be an opportunity that works in everyone's situation. So we are introducing it everywhere. And then your second question was, I think, given again the pension obligation, bond issue, we know it looms out there, right? We know you're doing a lot of work on that. Not sure where it ultimately all comes out. I think again, what we're trying to do for you folks, as you can appreciate, and all the comments that the board's made are fair and rightful. But we're just, we're trying to find a thoughtful opportunity for total return in an environment where base interest rates remain extraordinarily low, where we've got some of the broader challenges in the equity markets that I think we've all are well aware of and have lived through, and are just trying to be mindful and proactive with opportunities. So we like the opportunity in high yield right now. Historically, these levels have been rewarding points of entry for investors to do it in a modest fashion. But again, all the dynamics that have been mentioned, and obviously we won't stand in front of that, but I don't know that it completely degenerates the opportunity that we see in the space. So I don't know, Peter, to the question of whether it's an opportune time, we think it is, right? We're trying to run a diversified portfolio with a sensitivity and ability to generate total return, knowing we need total return, given the characteristics of the pension plan. And I thought this was a one place to do that in a measured manner. But again, I think all the input from the board is fair, and I know it's earnest, and I will abide by whatever you decide, of course.
Any other questions from anyone who's participating by phone that I can't see? This is Nancy speaking. Then I will make a motion at this point, and then Lori, we will look to you to take a roll call vote for us, please. The motion is to accept the recommendation from our investment advisor relative to the additional diversification that a high yield bond fund would introduce to the portfolio, but that we would continue to consider that, but we would not act on that recommendation at this point. I would like to add to the motion that we would want to circle back when we do the review for June 30 and relook at the high yield percentages in the MetWest portfolio at that time. So, Lori?
Okay. Peter?
Yes.
Brittany Bermingham?
No.
Alan Lebo?
No.
Eric Halpern?
No.
Lazaro Guzman?
No.
Nancy Dean?
Since I made the motion, I guess my answer is yes. However, I do want to have make sure that I made the motion correctly. So perhaps we are offline at this point, but I wanted to say that I was not recommending that we move into that high yield market on a specific basis at this point, only that I appreciated the recommendation from our investment advisor. And that we should take a look at this again after the fiscal year end. So I want to make sure that my motion was to not go forward, and I want to make sure did the no's mean you wanted to go forward?
Brittany Bermingham, I was thinking not going forward with the high yield.
So I think, this is Nancy, and my motion might not have been clear enough. I think you were agreeing with the motion, but
right. Okay. Yes, I can see that now.
But let's just I just want to clarify the whole thing. I don't know if you want me to do another motion to clarify, or.
Well, why don't you do for me, for the record, probably another motion would be helpful.
Better. Okay, so I would make a motion that we not consider entering into the high yield market at this point. How's that? now I will ask Lori to take the vote. Thank you, Lori.
Okay. Peter Privatera?
Yes. Well, I just want to qualify my previous vote. I understood what you were saying. We weren't moving into it now, but we would reconsider it later. So,
right.
Yes, now you're saying we're not moving into it. So my vote is yes.
It was a two-prong yes, no. All right.
Okay.
So, Peter, that was a yes?
That was a yes. Yes.
Brittany Bermingham?
Yes.
Alan Lebo?
I am against moving into high yield, whichever way that means here.
Yes.
I think that's a yes vote, Alan. Then this is Nancy speaking. Okay, thanks. That was my intention. Thanks.
Eric Halpern?
Yes.
Lazaro Guzman?
Yes.
And Nancy?
Yes. Okay. Thank you, Chris. It is always good to have concepts come before us and have us, kick the tires, so to speak. And I know that's what you folks do all day long up there. So it's very appreciated to make us go to the kind of edge of the table and think through these things. But I think that the board's decision at this point to wait is where we are. So thank you very much in that regard. There is one more item in this section, which is, and this is a older item carrying forward. I had Lori send the investment policy statement that we last affirmed in January of 19. As the months go by and with everything else moving on, some of these things really do need to follow their natural pattern of order. So I would like to make a motion that we reaffirm the investment policy statement that was included in your package, the one that has been as is since January of 2019. So the motion is to reaffirm the investment policy statement. Lori, if you would take a vote, please.
Sure. Peter Privatera?
Yes. Yes.
Brittany Bermingham,
Yes.
Alan Lebo,
Yes.
Eric Halpern,
Yes.
Roger Guzman,
Yes.
Okay.
and Nancy Dean.
Yes, so the motion carries. Thank you very much. Brittany, do you have anything from the town to bring up to us this
No, I have no updates at this time.
No updates at this time. All right, thank you very much. Rick, I think we have the meeting schedule printed in the package, which has already been approved. If anyone has any comments relative to that. And then I think Lori sent around also a query to a consideration to add a meeting in July. I felt that given all the movement in the market, all the movement in the financial situations here as part of COVID and everything else that's happening, that it would be appropriate for us to reconvene in July. Ordinarily, the schedule doesn't have us reconvening again, I think, until September. So I don't know if we have to do a vote to add that. Rick or Lori, do we need to do that? Or just put it on the calendar?
I thought I had read previously that it would be subject to a vote.
Okay. Then I will make a motion to add a regular scheduled meeting to our calendar for July 13th, 2020.
Okay. Peter Privatera,
Yes.
Brittany Bermingham,
Yes.
Alan Lebo,
Yeah, I vote yes. I would just note it would be preferable for me if it were July 20th, but I do vote yes for the 13th.
Okay.
Eric Halpern,
Yes.
Roger Guzman,
Yes.
and Nancy Dean.
Yes. And we will try to take that into consideration, Alan. I think now, once that we have this meeting scheduled, we can change that date with sufficient notice to the town clerk. We'll all look at our July 20 calendar. I will also check in with Chris and FIA because that may give them a little bit more time for cranking through the quarter end numbers. So we'll keep you posted, but thank you very much for adding that meeting. We now move to the formal section of the meeting, our formal actions. We have the minutes of our meeting, of the special meeting on Monday, April 20th. I will make a motion to approve the minutes for the virtual special meeting on Monday, April 20th, 2020. Lori?
Okay. Peter Privatera,
Yes.
Brittany Bermingham,
Yes.
Alan Lebo,
Yes.
Eric Halpern,
Yes.
Roger Guzman,
Yes.
and Nancy Dean.
Yes. Okay, thank you. The motion carries. Pension administration, we were catching up because we did have a special meeting where we did not cover any of these actions. Here to this point, Rick, I would ask, are there any terminations, refunds, disability applications, any of the items that are here that you would like to draw specific attention to by the board?
Thank you, Nancy. This is Rick Ledwith, Director of HR. It was a fairly routine transaction from a plan membership standpoint over the last couple of months. So we added 10 new employees to the pension plan, 6 non-vested withdrawals, 3 vested withdrawals, 9 normal retirements and 2 early retirements, 3 survivorship approvals. And then the one thing I would point out is there are 3 disability retirements on this agenda that had been previously approved by the pension board back pre-pandemic at that last meeting.
It just takes a while for these things to work their way through the system, right?
Yes.
Yes. Okay. I would then make a motion to approve pension administration matters that were included in your package. Is there any discussion or questions of these matters? They can be specific at this point. All right, then, Lori, I would ask you to take the vote, please.
Okay, Peter Privatera,
Yes.
Brittany Bermingham,
Yes.
Alan Lebo,
Yes.
Eric Halpern,
Yes.
Roger Guzman,
Yes.
and Nancy Dean.
Yes.
Okay.
And the vote carries. We also have some invoices for consideration today. There are 3 invoices that were attached for Reed and Riga, who is our legal counsel to the plan. I would make a motion that these payments be approved. I would open up if Rick has any specific additional comments on any of those invoices, either Rick or Peter. If not, I would also ask if anyone has any questions before we approve.
Rick Ledwith, Director of HR. So these 3 bills from John Jacobson and his team total $6,078, and they're regarding various issues that have come up over the last couple of months. One regarding ordinance changes. We had a military service question, contingent annuitant question, and then COLA contributions for members who are transferring between unions. Be happy to answer any questions that the board had.
Hearing none, Lori, I would ask you to take the vote, please.
Okay. Peter Privatera,
Yes.
Brittany Bermingham,
Yes.
Alan Lebo,
Yes.
Eric Halpern,
Yes.
Roger Guzman,
Yes.
and Nancy Dean.
Yes.
Okay.
And
All right.
the vote carries, and then the final vote housekeeping here is the quarterly investment management fee to fiduciary investment advisors. That's included in your package. We pay them on a flat rate basis. I would make a motion to approve that payment. Are there any questions, any discussion? Then, Lori, I would ask you to do the roll, please.
Sure. Peter Privatera,
Yes.
Brittany Bermingham,
Yes.
Alan Lebo,
Yes.
Eric Halpern,
Yes.
Roger Guzman,
Yes.
and Nancy Dean.
Yes.
Okay.
All right. I have no other items of business this morning. Does anyone else on the board have anything that they would like to raise at this point? Alan?
Yeah, I just, this is Alan Lebo, member of the board. Peter, at our last meeting, we, voted to update the valuation assumptions. And I just wondered whether you'd had any discussion with Milliman as to other ways of looking at this and what it means to us. And in particular, last time Chris mentioned that, we were looking at interest rates of like 6.25. If that was the valuation assumption, what amortization growth rate would we have to get to come up with a sort of similar ADEC to what we have now? I'm just curious as to what the implication is as to what it means for future funding if that turns out to be true. So I just wondered whether you'd had any discussions with Milliman about other ways of looking at this.
Pete Privatera, Finance Director. We had discussions on various ways to look at it. I think that if you recall, again, it's just from my perspective, it's managing that liability. We're faced with a significant increase based on the new mortality tables and all that, and that we adjusted the amortization growth rate well, but I haven't seen the final valuation yet. We haven't talked since the board take action. And frankly, if they have any recommendations on how to manage this pension liability moving forward, I'm all for it. I think that, one area that we're, that we discussed and hopefully we'll take some action on it to manage this moving forward are the pension obligation bonds, where, we'd stabilize our prior service liability, and then we'd have to worry about our normal costs moving forward and how to stabilize that. So other than the POBs, we haven't had any other discussions.
Okay, yeah, I was just curious about what it might mean in terms of amortization growth rate in particular.
Is that a question? I'm sorry.
Well, yeah. I just, in discussing with Milliman, I understand we need to come up with realistic evaluation here. I'm just trying to understand if Chris's latest projection is more accurate, what that means as far as an amortization growth rate, and what kind of funding that would mean we need in the future.
Pete Privatera, Finance Director. I wish I had the answer to that. It all depends on a few things. Number one, next year we're going to be smoothing in the second half of the mortality tables. Right. That'll have an impact. Next year, we may have an additional discussion on further reducing the discount rate by another eighth or so. Next year, we may be talking about the impact of the pension obligation bonds if we sell them. I mean, there's a lot of variables out there. And again, I would say we tweaked the amortization growth rate to basically allow us to manage the growth. Otherwise, we'd be looking at multi-million-dollar increases. So, I mean, there's still a lot of variables at play here. Alan, I wish I knew, but it's the best I have right now.
I'm sorry, I understand all that. I guess what I'm asking is, would you be amenable to asking Milliman to take a look at what it would mean if we used 6.5 or 6.25, what that would mean to the amortization growth rate to come up with a similar ADEC to what we have today?
I could ask him to do that, but if we dropped our discount rate down to 6, and I'm trying to understand, because you're saying that if we had a 6.75% discount rate, what would that do to how do we have to change the amortization growth rate? Is that what you're asking?
Yeah, I'm not asking you to change any of our assumptions. I'm asking you that if you looked at it and said, if our assumption was 6.5 or 6.25, what would that mean then the amortization growth rate would be to come up with a similar ADEC to what we have today?
Okay, I mean, I can ask him that, but the amortization growth rate would have to increase. Otherwise, our liability.
Yeah.
Right.
Right. Okay.
Okay. Any other questions? See anybody else here? Okay. I would like to thank everyone for participating in this virtual regular scheduled meeting. We'll get a little better at this each time we do it, and I think we may be doing it this way for a while. So I appreciate your participating and your working the process through with me every time. So with that, I will make a motion to adjourn. Lori?
Sure. Peter Privatera.
Yes.
Brittany Bermingham.
Yes, thank you, Nancy.
You're welcome.
Alan Lebo.
Yes.
Eric Halpern.
Yes.
Lazarus Guzman.
Yes.
Okay.
And Nancy.
Yes, I will approve my own motion, and I would say this is great. Thank you. We have made it to 8:50. I know everybody else has some pressing business to carry on with their day. Chris, thank you very much for bringing everything that you bring to the table here for us, and I know that we will want to dig deeper as we go forward and look towards the results of this second quarter. So thank you.
Thank you, Nancy.
Everybody,
Have a good
everybody
week.
stay safe. Thank you very much.